Hey everyone, I'm David Finz. And on this episode of the Cyber Insurance Imperative, we're going to talk about the non event that happened at Lloyd's of London earlier this month, which started out as a tempest but turned out to be much ado about nothing. Here's what we now know. During the first week of October, unusual activity was detected on Lloyd's network, and the decision was made to preemptively take the network offline and conduct a forensics investigation. The in-house team at Lloyd's was supported by two experienced outside service providers. Following what CEO John Neal described as an extensive investigation, the incident response team determined that the network could be restored and that there was no evidence of a compromise either to the network or to any data. Both of the outside vendors provided assurance statements around their findings, and notice was given to both domestic and international regulators about the incident. As of this recording, the network was due to be brought back online by the 12th night of October, and every market participant was being given the necessary resources to safely reconnect. Lloyd's was proactive in shutting down their network, and thankfully, all's well that ends well. They've been able to bring this incident to a favorable resolution. But there's a lesson in here for businesses of all types: the importance of being able to conduct a voluntary shutdown to safeguard their network and data when necessary. Now, most cyber insurance policies cover the income loss and extra expense associated with an interruption to your network. But the question is, what must happen to trigger coverage? A deliberate attack, or security failure as it is sometimes known, is the most common scenario to trigger coverage, and many policies also provide a coverage trigger when the network is taken down by a comedy of errors or system failure. But what happens when your business detects suspicious activity on the network, as Lloyd's did, and makes a decision to take the network offline to investigate and prevent any further harm? Friends, don't assume that this scenario is covered. You may have to ask your broker to speak to the underwriter about adding this coverage trigger by endorsement, because it may not be in the base policy form. Without that expansion of the coverage trigger, the profits you lose and the costs you incur coming up with workarounds may not be covered under your policy. This is another example of the type of coverage enhancements that we negotiate for our clients to make sure that your policy performs as you like it when a claim arises. If you would like a copy of our white paper, coverage typically available in the market, you can DM me on LinkedIn or email me at david.fins@alliant.com. It's just one more way that Alliant helps you find the more rewarding way to manage risk. Thanks for watching.